Over $1 trillion vanished from global markets in a single week. Not slowly, not gradually. In days, the perceived value of countless portfolios, retirement accounts, and corporate balance sheets simply evaporated. Investors are scrambling to understand if this is a routine correction or the opening act of something far worse. In the next few minutes, we'll break down where that money actually went, why panic moves faster than reason, and what happens when confidence collapses across the entire system. Have you ever seen those news headlines? Trillions wiped off global markets. It sounds terrifying, like a cosmic thief just vacuumed up everyone's life savings. But have you ever stopped to ask the really simple question? Where does all that money actually go? Did someone find it? Is it stuffed under a giant mattress somewhere? Is there some vault where all the disappeared wealth gets stored, waiting to be redistributed? The answer is both simpler and much more fascinating than that. And stick around, because by the end of this, you'll understand market crashes, the power of confidence, and what it all has to do with a can of baked beans. Let's start with a basic idea. Imagine you own a house. A year ago, your neighbor sold an identical house for $500,000. So, on paper, your house is worth $500,000. You feel pretty good about that. You might even start thinking about the things you could do with that equity. Maybe you consider a home equity line of credit. Or you just feel wealthier in general, more secure about your financial position. But then, the economy takes a turn. Your new neighbor, who's in a hurry to move, sells their identical house for just $400,000. Suddenly, the market value of your house is now $400,000. You've just lost $100,000. But did that money go anywhere? No, it never existed as physical cash in the first place. It was just a number. A potential value based on what someone else was willing to pay. It was a consensus, an agreement between buyers and sellers about what this type of property should cost. And when that consensus shifted, the value simply vanished into thin air. Nothing moved from your account to someone else's. The wealth was theoretical, and now it's theoretically gone. The stock market works in a very similar way. When you buy a share of a company, say Apple, you're buying a tiny piece of ownership in that company. The price of that share isn't determined by some universal law or carved into stone tablets. It's determined by supply and demand. It's the last price someone was willing to pay for it. If lots of people want to buy Apple stock and not many want to sell, the price goes up. Buyers have to offer more to convince sellers to part with their shares. If more people want to sell than buy, the price goes down. Sellers have to accept less to find someone willing to take the shares off their hands. Every transaction sets a new benchmark, a new agreed-upon price that determines the value of every other share of that company, even the ones that haven't traded hands. So when the news screams that $1 trillion has been lost, what it really means is that the total perceived value of all those shares has decreased by $1 trillion. That money wasn't in a big pile to begin with. It wasn't sitting in a bank vault or a corporate treasury. It was theoretical wealth, an agreed-upon value based on the most recent transactions and the collective belief about what those assets should be worth. When a market crashes, that agreement changes and the value evaporates. No one gets richer by the exact amount someone else lost. It's not a transfer of wealth, like money moving from one pocket to another. It's a destruction of perceived wealth. The market is essentially a continuous auction where prices are discovered through the constant interplay of buying and selling. When the mood shifts, when the collective psychology changes, those discovered prices can plummet. And when they do, trillions in paper wealth can disappear faster than you can refresh your portfolio screen. Now, why does this happen? What causes millions of people to suddenly decide a company is worth less than it was yesterday? One of the biggest drivers is panic. Imagine you're in a crowded movie theater and someone yells, "Fire!" Even if you don't see smoke or flames, your first instinct is to run for the exit. You see other people running, and that reinforces your decision. You don't want to be the last one out. You don't have time to investigate whether there's actually a fire. You see movement, you hear alarm, and your survival instinct kicks in. Better safe than sorry, right? Panic selling in the stock market is the financial equivalent of that. A piece of bad news comes out. Maybe it's a new economic policy that threatens corporate profits. Maybe it's some major company reporting poor earnings that raises questions about the health of an entire industry. Maybe it's a global crisis, a geopolitical event, or an unexpected shock to the system. A few investors get nervous and decide to sell their stocks to lock in their profits or cut their losses before things get worse. Other investors see the price starting to dip, and they get scared. The downward movement itself becomes information. They think, I'd better sell now before the price drops even further. This creates a snowball effect. The more people sell, the faster the price falls, which scares even more people into selling. This is a self-fulfilling prophecy. The fear of a crash is what actually creates the crash. It's a massive, collective loss of confidence. And because markets move on emotion as much as logic, that fear can spread faster than any rational analysis can counter it. You don't have time to carefully weigh the fundamentals of a company when you see your portfolio value dropping by the minute. The instinct to protect what you have takes over. This is where things get really serious because the stock market isn't just a game for Wall Street traders in expensive suits. It's deeply connected to the real economy, to the lives of ordinary people. Many of us have our retirement savings like a 401k or an IRA invested in the market. We're told from a young age to invest for the future, to build wealth over time through the power of compound returns. When the market crashes, our retirement accounts shrink. That's real money we were counting on for our future. It's not just numbers on a screen. It's the difference between a comfortable retirement and financial insecurity. It's years of careful saving suddenly worth significantly less. But the impact goes even wider. This is where global interdependencies come into play. Our modern world is a tightly woven web of financial connections, trade relationships, and economic dependencies. A bank in Europe might hold investments in American companies. A factory in Asia might make parts for products sold in North America. A pension fund in Australia might own shares in European corporations. A market crash in one country doesn't stay there. It sends shockwaves across the globe, rippling through every interconnected system. Let's say the US market has a major downturn. European banks see the value of their American investments plummet, making them financially weaker. Their balance sheets take a hit. This might make them less willing to lend money to businesses in their own countries. Credit tightens. Meanwhile, American consumers, feeling poorer because their investment portfolios have been hammered, start spending less. The wealth effect works in reverse. They put off buying a new car or renovating their kitchen. They cancel vacation plans. They decide that big purchase can wait. This reduced demand means that Asian factories that produce car parts or home goods get fewer orders. Their order books start to thin. They might have to lay off workers or reduce shifts. Suddenly, a problem that started in New York is causing job losses in Seoul and Frankfurt. A crisis that began on trading floors is now affecting factory workers, small business owners, and families trying to make ends meet. Instability spreads like a virus through these global connections, amplifying the initial shock. What starts as a financial problem quickly becomes an employment problem, which becomes a spending problem, which circles back to being an even bigger financial problem. And this brings us to consumer confidence, which is perhaps the most important link between Wall Street and Main Street. Remember our baked beans? Imagine a can of beans costs $1. You're not worried about your job, and you feel financially secure. Your retirement account is doing fine. You hear positive news about the economy. You go to the store and buy your beans without a second thought. You might even grab a few extra cans. You might pick up some other items you don't strictly need but would be nice to have. The economy hums along because millions of people are making these small, confident purchasing decisions every single day. Now, imagine the stock market has just crashed. Your retirement account is down 30%. The news is full of stories about layoffs and economic uncertainty. You hear rumors about potential layoffs at your company. Even if you still have your job and the can of beans still costs $1, you might think twice. Maybe I should save that dollar just in case, you think. Maybe I'll eat what's already in the pantry. The bean costs the same. But your perception of your financial security has changed completely. That perception shift changes your behavior. Now multiply that single decision by millions of people. When consumer confidence drops, people stop spending money on everything from beans to cars to vacations. They delay purchases. They cut back. They hoard cash. This is devastating for businesses. They see their sales fall, their profits disappear, and they're forced to cut costs, which often means freezing hiring or laying off employees. A business that was thriving a month ago suddenly finds itself struggling to meet payroll. This in turn makes even more people lose their jobs and their confidence, leading to even less spending. It's a vicious downward spiral that can pull the entire economy into a recession. The loss of wealth on paper becomes a very real loss of jobs and economic activity. What started as theoretical becomes painfully concrete when you are the one receiving the pink slip or watching your business fail. So, when the market is in freefall and confidence has evaporated, what can be done? This is when governments and central banks often step in. Their goal is to stop the bleeding and restore stability. You can think of them as the firefighters arriving at the scene. The building is burning and they need to prevent the fire from spreading to the entire neighborhood. One of their main tools is monetary policy. Usually controlled by a country's central bank, like the Federal Reserve in the US, they can cut interest rates. Lower interest rates make it cheaper for businesses and individuals to borrow money. The hope is that this will encourage companies to invest in new projects, to expand rather than contract. And it should encourage consumers to start spending again, perhaps taking out loans for cars or homes because the cost of borrowing is now more attractive. This stimulates the economy by making capital cheaper and more accessible. They can also engage in something called quantitative easing. This is a fancy term for the central bank creating new money to buy financial assets, like government bonds, from commercial banks. This pumps cash directly into the financial system, which is intended to increase liquidity and encourage banks to lend more freely. It prevents a credit crunch where no one can get a loan, where businesses can't access the capital they need to operate, where the financial system ceases up completely. By buying these assets, the central bank puts money into the hands of institutions that can then circulate it through the economy. On the other side, you have government intervention through fiscal policy. This means the government can increase its spending or cut taxes. They might launch large-scale infrastructure projects, like building roads and bridges to create jobs directly. These projects put people to work, give them paychecks, and inject money into local economies. Or they might send stimulus checks directly to citizens, hoping they will go out and spend the money, boosting consumer demand. The idea is to replace the spending that consumers and businesses have pulled back from. If the private sector won't spend, the government will, at least temporarily, to keep the economy moving. These interventions are often controversial. Some argue they are essential to prevent a complete economic collapse, like the actions taken during the 2008 financial crisis or the COVID-19 pandemic. Without intervention, they say, the downward spiral would continue unchecked, leading to a depression rather than a recession. Others worry that these policies can lead to inflation down the road, that creating too much money or spending too much government money will eventually devalue the currency and cause prices to rise. They also worry about creating a moral hazard, where banks and investors take excessive risks knowing the government will bail them out if things go wrong. If you know someone will catch you when you fall, you might be more willing to walk on a tightrope without a safety net. But in the heat of a crisis, when trillions have vanished and panic is rampant, the primary goal is to restore one crucial ingredient: confidence. By stepping in, governments and central banks are sending a powerful message to the market. They're saying, we will not let the entire system collapse. We are here to provide a backstop. This assurance can be enough to calm the panic, stop the frantic selling, and give the market a floor from which it can begin to slowly recover. It's about breaking the psychological spiral. When investors know there's a limit to how bad things can get, when they see that powerful institutions are committed to stabilization, they stop running for the exits. The theater might still have smoke, but someone credible is saying the fire is under control. That message matters. So to recap, when you hear that trillions of dollars have been wiped out, that money didn't go into someone's pocket. It didn't transfer to some hidden account. It was perceived value that simply evaporated when collective confidence was lost. This loss is triggered by panic, by the human instinct to protect what we have, which spreads like wildfire due to our interconnected global economy. The resulting drop in consumer confidence can cripple the real economy, leading to job losses and recessions that hurt real people in real ways. Finally, governments and central banks must often intervene with powerful tools to stop the panic and rebuild the confidence that is the true foundation of our financial markets. It's a fragile system, built as much on human psychology as it is on numbers in spreadsheets. Understanding that the lost money never really existed in a physical sense is the first step to understanding the strange, powerful, and sometimes terrifying world of finance. We live in an economy where belief shapes reality, where confidence creates value and fear destroys it. That's not a weakness of the system. In many ways, it's the system itself. Markets are collective agreements about value, and those agreements can change in an instant. Thanks for watching. If you found this breakdown helpful, be sure to hit the like button and subscribe for more explanations of the complex world around us. See you next time.